Okay, taking a look at exercise 11-17. So a restaurant with investments by 3 partners that are given there. First year of operations didn't go well. They decided to liquidate, sharing all losses equally. After all assets are converted to cash and the creditors are paid, only $60,500 in cash remains. Part 1. Calculate the capital account balance of the partners after the liquidation of assets and payment of creditors. So we have their initial investments given there in the question, $233,700, $177,700, and $192,100, which totals $603,500. We're told that only $60,500 in cash remains. So the difference between the $603,500, what it was at the beginning, less the remaining $60,500, the difference is the amount of the loss. And that amount is divided by 3 because it's getting shared 3 ways equally between each one of the partners. So each partner's share of the loss is $181,000, which then gives us the new balance in their capital account. Now in part 2, we are to assume that any partner with a deficit pays cash to the partnership to cover that deficit, and then we're to do the journal entry to record the receipt of the cash and the final disbursement of cash to the partners. So the receipt of the cash is straightforward. We debit cash by the amount of the deficit that she's paying, $3,300, and we credit her account to bring it back up to 0. Then the cash balance would have been $60,500, but we add that $3,300 to it to bring it to $63,800, and then that gets distributed out to the remaining 2 partners, $52,700 and $11,100. Part 3, we are to assume that the partner is not able to pay the deficit, and we are to record the entries to transfer the deficit to the remaining partners and to record the final disbursement of cash. So here we still credit her capital account, Eva's account, to bring it out of a debit position to bring it back to 0. And then that amount gets shared equally between the other 2 remaining partners. So in effect then what we are doing is here is their balance in their capital account. We are reducing it by $1,650. So the next step then is to distribute that amount that's left over. So now they have a new balance in their account. It's $52,700 minus $1,650 and $11,100 minus $1,650. So that amount then gets a debit to their capital account now to bring it to 0 and a credit to cash. So obviously we can see here the difference is if the partner with the deficit pays it, then the remaining partners' capital accounts remain the same, but the total increases because we're taking this deficit out. If the partner with the deficit cannot pay it, then the total stays the same, but we have to distribute this loss, this deficit, over the remaining 2 partners' accounts.